One major advantage for revenue recording using the cash accounting principle is that it's relatively simple to implement. If cash inflows happen and those cash flows meet the definition of revenue, they'll be recorded as such. Another advantage of the cash basis of recording is that the data provide a clear view on liquidity. Now you could ask, why do we bother to implement a relatively complex principle that states flows are recorded at the time economic value is created, transformed, exchanged, transferred, or extinguished? And even more importantly, what does this actually mean? To understand how accrual recording of revenue works and what the benefits are compared to cash recording, let's look at an example. Many taxes are paid with time lags. Businesses, for instance, typically pay taxes on their profit. However, the assessment of profits for financial reporting and tax purposes is often challenging for accountants, and it may take quite some time to be assessed. Sometimes the final profit tax is only determined 1 or 2 years later. The cash inflows for profit taxes may thus be, and often are, related to earlier reporting periods. Let's look at the following chart with simulated quarterly data. The green bars show the profit tax as it is received, the cash flows. The blue bars show the tax owed due to profits generated in each respective quarter, the accrued flows. If we assume that for some businesses there is a lag of 1 or 2 quarters, the cash revenue in quarter 3 will actually be related to 3 different quarters. As a result of this time shift, you may observe quite different time series on an accrual or a cash basis. The cash basis of accounting would show the profit tax revenue when the cash is received. Of course, this is a valid and important view as it tells you something about the government's cash position, that is, its liquidity. However, the linkage is lost between when the economic activity takes place and when the associated tax payment is reported. If we use the accrual principle, we will record the revenue amounts in the periods when the taxable event occurred. This means that initially we will use the best estimates to project the revenue and later revise the historical data based on the actual amounts due and received. This will allow an analyst to conduct important tax analysis, such as studying the impact of a tax reform or cyclical patterns related to economic growth. Accrual data is also important to separate revenue properly at the boundaries of the reporting period. There are often rollover effects where revenue related to a specific period is received a little later or earlier than in previous periods. Simply following the cash flows may thus distort the aggregates and balancing items. Finally, without accruals, we're also blind to non-cash elements. We've no way to record and analyse the impact of in-kind transactions, such as large non-financial assets being received as a capital grant.